You know, when a city starts experiencing a massive economic boom, everyone immediately looks at the shiny new skyscrapers going up.
Right. It's human nature.
Yeah, you see the steel frames, the massive glass windows reflecting the sun. It's very binary. You either have the biggest, most impressive building on the block, or you just don't.
Oh, absolutely. I mean, we focus on the monument, right? The sheer scale of the construction is what grabs the headline. We see a 100-story tower, and we just assume that's where all the value is concentrated.
But the thing is, you don't build a 100-story tower without eventually hitting a logistical wall. I mean, how is everyone actually going to get to the 100th floor?
Exactly, the elevators.
Right. If you just have a basic set of stairs or, I don't know, a slow, outdated elevator system from the 1990s, that beautiful new skyscraper is essentially useless.
It becomes a bottleneck.
Yeah, you can have 1 million square feet of premium office space, but if it takes 3 hours for employees to reach their desks, the building fails.
And in the modern tech landscape, the people inside that building, they are the data.
Exactly. You need a massive, high-speed, almost invisible nervous system moving everything up and down, side to side, just continuously.
Which is the absolute definition of an infrastructure bottleneck. I mean, the building is only ever as good as the plumbing, the electrical grid, and the transit systems integrated into its core.
If you don't have the elevators, the skyscraper is an empty shell. And right now, Marvell Technology is building the elevators for the global AI boom.
They really are.
So today on this Talk Takers Deep Dive, we are breaking down Marvell's Q1 fiscal 2027 earnings call. We're looking at ticker symbol MRVL, and the headline here is just staggering.
It's massive.
Marvell just walked up to the microphone and raised their revenue outlook for next year by $1.5 billion, not million. Billion.
It is a stunning upward revision. I mean, especially considering the current macroeconomic environment, right? To understand how a company can confidently project an additional $1.5 billion in revenue, we really have to look at their evolution. The sources we're analyzing today, the raw transcript from their Q1 call, the management commentary, the Q&A session with analysts, they all point to this profound metamorphosis.
A complete identity shift.
Exactly. Marvell is no longer a legacy semiconductor company making chips for, consumer electronics or standard enterprise hard drives. They have transformed into the critical nervous system for global AI infrastructure.
Let's get straight into the data, because the absolute scale of what they are reporting requires some serious unpacking.
Let's do it.
Looking at the first quarter of fiscal 2027, Marvell delivered a record revenue of $2.418 billion.
Which is huge.
Right. That is up 9% sequentially from the previous quarter and up 28% year over year. They beat the midpoint of their own guidance. But what stands out to me isn't just the top-line number, it's the composition of that revenue.
The composition is the entire thesis here. Data center revenue alone was $1.83 billion.
Wow.
Yeah, that represents 76% of their total revenue.
I just want to pause and think about that, 76%. If you are an investor looking at Marvell, you are essentially looking at a pure-play data center company at this point.
Absolutely.
That specific segment is up 11% sequentially and 27% year over year.
The identity of the company has decisively shifted. And when we look at the profitability, the non-GAAP EPSO earnings per share came in at 80 cents. That is a 29% increase year over year, beating their guidance.
Okay, I have to stop you right there.
Sure.
Because if you are a retail investor scanning your financial dashboard, you're going to see a completely different set of numbers that look, frankly, terrifying.
Yes. The GAAP numbers.
Yes, I'm looking at the GAAP numbers.
Right.
The generally accepted accounting principles numbers, and it looks like a disaster. The GAAP EPS dropped to just 4 cents.
Right.
4 cents. If I see an 80-cent non-GAAP EPS and a 4-cent GAAP EPS, my immediate assumption is that management is hiding massive operational losses behind clever accounting tricks. Like, are they just bleeding cash?
I completely understand the skepticism, and honestly, it's exactly the right instinct to have when you see a 76-cent gap between GAAP and non-GAAP earnings.
That's a massive gap.
It is, but let's test that assumption by looking at where the money actually went. Marvell isn't bleeding cash from their day-to-day operations. They are taking a massive planned accounting hit because they just closed 2 major strategic acquisitions in the first quarter, Celestial AI and XCOM.
So this is an accounting artifact of buying other companies.
Exactly.
But how does buying a company drag your reported earnings down to 4 cents without actually, impairing your cash flow.
Well, it really comes down to how GAAP accounting treats intangible assets. When Marvell buys Celestial AI, they aren't just buying office furniture and servers.
Right, they're buying the tech.
Yeah, they're buying patents, proprietary silicon photonics designs, customer relationships. GAAP requires you to value those intangible assets and then amortize them.
Okay, amortize them meaning what exactly?
Meaning you have to deduct a portion of their value from your reported earnings every single quarter over a set number of years. You also have one-time restructuring costs and acquisition-related earnout obligations hitting the books all at once.
Okay, so they write a check to buy Celestial AI, but then the accounting rules force them to record these kind of phantom expenses on their income statement for years, even though no new cash is actually going out the door for those amortizations.
Precisely. It's like buying a highly lucrative rental property.
Okay.
Your checking account takes a massive hit today because you paid the down payment and the closing costs. If you look at your ledger that month, it looks like you were deeply in the red.
Because you just spent hundreds of thousands of dollars.
Right, but you didn't burn that money. You converted it into an asset that is going to generate a massive yield.
That makes sense.
And the proof that Marvell's core business is healthy lies in their non-GAAP gross margin, which isolates the actual cost of making and selling their physical products. It came in at a phenomenal 58.9%.
Nearly 60% gross margin on physical hardware. I mean, that implies they have incredible pricing power.
Oh, definitely.
You don't pull a 60% margin if you are selling commoditized chips. You only get that if you're selling something your customers literally cannot get anywhere else.
And look at the cash flow. Their cash flow from operations was a record $639 million in the first quarter alone.
Wow.
Yeah, a company that is fundamentally struggling with profitability does not generate over $600 million in cold, hard cash from its operations in a single quarter.
No, of course not.
Willem Meintjes, their CFO, specifically addressed this on the call. He pointed out that they had delivered 6 consecutive quarters of positive GAAP net income prior to this specific acquisition hit, and they expect GAAP EPS to normalize right back up to the 32 to 42 cent range in the very next quarter.
Okay, so the checking account is low because they bought the building. The 4-cent EPS is just a temporary pothole on a very fast highway.
Right.
So they bought Celestial AI and XCon. But what exactly are those companies doing that justifies taking that GAAP hit right now? What is the operational crisis Marvell is trying to solve that drove them to make these acquisitions?
It all comes down to a fundamental paradigm shift in AI architecture. In the earnings call, Matt Murphy, the CEO, spent a significant amount of time highlighting their interconnect business.
Okay.
Previously, they had modeled this interconnect business to grow by 50% year over year. On this call, they revised that forecast upward to over 70% growth.
Wait, a 70% growth rate for physical network infrastructure?
Yeah, 70%.
We hear about AI chips constantly.
Yeah.
The conversation is entirely dominated by GPUs, raw compute power, and massive server racks.
Right, the brains.
But Marvell makes the networking gear, the switches, the optical cables, the custom silicon that connects those GPUs together. Why is the networking suddenly growing at 70%? Why is the transit system suddenly demanding as much capital as the processors themselves?
Because the nature of the processor's workload has totally changed. We are transitioning from the early stages of generative AI to what management calls agentic AI and reasoning models, specifically mixture of experts or MOE models.
Let's break down the physical hardware implications of that. Because if you ask a layperson, an AI is just a chat box on a screen.
Right, you type a prompt, you get an answer.
But underneath, the physical routing of data is vastly different between a basic generative model and a mixture of experts model, man.
Hugely different. Think about the early days of generative AI. The primary bottleneck was just raw compute power and memory capacity inside a single localized cluster.
Okay.
You trained a dense model, you asked it a question, and it generated an answer. It was a single linear process. The data traveled north-south, meaning it went from the user down into the server, processed locally, and sent back up to the user.
But a mixture of experts model doesn't work like that. It's not one giant monolithic brain calculating every single word.
No, it is highly decentralized. And MOE model consists of multiple specialized subnetworks, or experts.
Right.
When you send a prompt, a router network evaluates your request and decides which specific experts need to handle which parts of the task. So a single user request might require the AI to constantly query dozens of different submodels running on completely different server racks across the data center.
And with agentic AI, it goes even further. An AI agent might be tasked with a complex goal like book me a flight, a hotel, and draft an itinerary.
Exactly.
To do that, the agent has to autonomously spawn sub-agents, query external APIs, evaluate the responses, and communicate back and forth with itself hundreds of times before it ever shows the user a result.
Yes. The amount of east-west traffic, the data moving laterally between different servers and different GPUs, explodes exponentially.
East-west traffic, meaning machine to machine.
Exactly. The bottleneck is no longer just how fast a single GPU can think. It's how fast millions of GPUs can talk to each other to coordinate that thought. And because these models are now so massive, spanning hundreds of billions or even trillions of parameters, they can no longer fit inside a single data center due to the physical limits of power grids and cooling systems. The cluster literally has to span multiple data centers.
Which brings us to the core of Marvell's value proposition. If the cluster spans multiple buildings, you need a high-speed highway connecting them.
They are providing the 800 gigabit and 1.6 terabit optical connections to make that possible.
1.6 terabits.
Yeah, their 1.6T solutions, running at 200 gigs per lane, are ramping up production aggressively this year. They even demonstrated 400 gig per lane technology at the recent optical fiber conference. They are constantly pushing the absolute boundaries of physics to force more data down a single fiber optic thread.
And this isn't just a broad generic market trend either. The transcript details a very specific, deeply integrated partnership with NVIDIA.
Yes, a massive partnership.
They announced a major collaboration integrating Marvell's custom silicon and optical networking directly into the NVIDIA ecosystem. What does that actually look like on a technical level?
So the partnership is structured around 3 strategic pillars, and it forms a really massive competitive moat.
Okay, what's the first pillar?
The first pillar is optics. Marvell has always been a leader in supplying DSPs, digital signal processors, and optical drivers, but now they are collaborating with NVIDIA on silicon photonics technology.
Silicon photonics. We really need to dissect this because it sounds like science fiction. We are talking about using lasers and light to move data between microchips instead of using electrical currents over copper wires.
We have to move to light because copper has basically reached its physical limits at these data rates.
Really? Copper is maxed out.
Yeah, when you push electrical signals at 200 gigabits per second over a copper trace, the signal degrades almost instantly due to electrical resistance, crosstalk, and something called the skin effect.
The skin effect.
Yeah, the energy turns into heat, and the data just becomes unreadable noise over distances longer than a few inches.
So to keep the latency low, when the brain of the AI is the size of 3 city blocks, you literally have to convert the electrical data into photons, shoot it over fiberglass, and then convert it back to electrons at the destination.
Yes, exactly. And the second pillar of the NVIDIA partnership is NVLink fusion integration.
NVLink.
Right, NVLink is NVIDIA's proprietary ultra-high-speed interconnect protocol. It's how they connect their GPUs together so they can share memory and essentially act as one giant mega GPU.
But NVLink is a closed ecosystem. It's NVIDIA's walled garden. How is Marvell getting inside?
Because the massive cloud providers, the hyperscalers like AWS, Google, and Microsoft, they don't want to be entirely locked into a closed ecosystem.
Ah, of course.
They want to use NVIDIA GPUs for the heavy lifting, sure, but they also want to design their own custom silicon accelerators for their specific proprietary algorithms. Marvell builds the Fusion Bridge.
Fusion Bridge.
Yeah, they create custom chips that seamlessly translate between the hyperscaler's proprietary architecture and NVIDIA's NVLink protocol.
Wait, so if a cloud provider wants to plug their own custom-built chip directly into an NVIDIA H100 cluster without suffering a massive latency penalty, Marvell is basically the only tailor in the world who can stitch those two different fabrics together.
That is the perfect way to visualize it.
That's incredible.
And the third pillar of this partnership pushes even further to the edge of the network. It's called AI-RAN. That stands for Artificial Intelligence Radio Access Network.
Radio access networks. We're talking about telecommunications now.
Yeah.
Like cell phone towers.
Yes. The concept of AI-RAN is to integrate AI directly into the wireless telecommunications infrastructure.
Okay, how does that work?
Right now, a 5G cell tower has a baseband processing unit sitting at the bottom of the tower, and their only job is to manage radio frequencies. It's highly specialized, single-purpose hardware.
And most of the time, especially at night or in quiet areas, that compute power is just sitting there idle.
Exactly. AI-RAN allows telecom operators to run their 5G or 6G network operations and high-performance AI applications on the exact same unified hardware platform. You can dynamically allocate the compute power. If the cell tower doesn't need all its processing power to manage phone calls at 2 a.m., it can spin up AI inference workloads right there at the edge of the network, incredibly close to the user.
Which bypasses the need to send data all the way back to a centralized cloud data center.
Precisely.
That is efficiency at a globally transformative scale. You literally turn every cell tower in the world into a localized AI mini data center.
It's a huge shift in how we think about compute.
Let's circle back to the photonics side of this, because I found a detail in the transcript that is just fascinating. They mentioned they recently acquired a company called Polariton, which develops plasmonics-based silicon photonics devices.
Yes, plasmonics.
Now, standard silicon photonics uses light. What in the world is plasmonics, and why is Marvell buying up that specific intellectual property?
So this is where we look past the next 2 years and start looking at the next decade. This raises a fundamental question about the diffraction limit of light. Traditional silicon photonics are incredible, but they have a scaling problem.
Let's define the diffraction limit for the listener.
In basic physics, you generally cannot confine light to a space smaller than its own wavelength.
Okay.
A photon of light used in telecommunications has a wavelength of about 1,550 nanometers. But the electronic transistors processing the data are down in the 3 nanometer or 5 nanometer range.
So you have a massive size mismatch. The electronics are microscopic, but the optical components, the modulators that convert the electricity into light, have to be comparatively huge just to fit the light wave inside them.
That size mismatch creates a bandwidth ceiling and a major power efficiency problem. As we try to push data rates past 1.6 terabits to 3.2 terabits and beyond, traditional optical modulators become too large and require too much voltage to operate efficiently.
And plasmonics solves this. How?
Plasmonics operate at the nanoscale by coupling the photons of light with the electrons on the surface of a metal.
Coupling light and electrons.
Yeah, it creates something called a surface plasmon polariton. It's essentially a hybrid of light and electricity. By doing this, you can squeeze the optical signal into dimensions far smaller than the wavelength of the light itself.
You're tricking the light into behaving like an electron, so you can shrink it down to the size of modern transistors.
Precisely. It allows you to dramatically shrink the size of the optical components while massively increasing the speed at which you can modulate the data onto the light wave.
Oh, wow.
They bought Polariton to ensure that when the industry inevitably hits the wall of traditional photonics and desperately needs 3.2 terabit speeds, Marvell holds the foundational patents on the underlying physics required to make it happen.
They already have 15 billion hours of field data across 4 generations of their silicon photonics deployments. I mean, they aren't experimenting in a lab. They are deploying this at scale.
They really are.
So the nervous system is scaling up dramatically. The technology is moving from copper to light, from single data centers to multi-site clusters, and eventually from standard photonics to nanoscale plasmonics. If the technology is accelerating this fast, what did management say about the financial timeline? When does this translate into revenue?
Let's look at the management guidance, because this is where the transcript just explodes with optimism.
The forward-looking guidance is truly the centerpiece of the narrative here. Let's look at the immediate near term. For the second quarter of fiscal 2027, they guided revenue to $2.7 billion, which is a 12% sequential increase.
But the CEO explicitly noted that they expect to hit a $3 billion quarterly run rate by Q3. That is a full quarter ahead of their previous schedule.
Yes.
In the hardware world, accelerating a massive production ramp-up by an entire quarter is incredibly difficult.
It requires flawless execution in the supply chain. For the full year of fiscal 2027, they are guiding for total revenue of approximately $11.5 billion. That represents 40% year-over-year growth.
40%.
Yeah, growing a multi-billion-dollar semiconductor business by 40% in 12 months is practically unheard of outside of an absolute generational supercycle. And yet, the real jaw-dropper was their outlook for the following year, fiscal 2028. They raised their revenue outlook for FY28 by $1.5 billion, projecting approximately $16.5 billion in total revenue.
Right.
Within that figure, data center revenue alone is expected to grow by another 55% year over year.
To understand how to get to $16.5 billion, we have to isolate the custom silicon business. They expect their custom silicon revenue to more than double year over year in fiscal 2028.
Wow.
During the Q&A, an analyst modeled out the trajectory, and Matt Murphy essentially confirmed that they are tracking toward $10 billion in custom silicon revenue alone by fiscal 2029.
Custom silicon tracking to $10 billion. Let's dig into why the major cloud providers are abandoning off-the-shelf chips and demanding custom solutions.
It's all about efficiency.
During the call, Harlan Sur from JP Morgan pressed management on SRAM-based memory architectures and how Marvell leverages its IP in that specific area. He pointed out that highly efficient, low-latency inferencing engines, the kind of specialized chips NVIDIA was chasing when they bought Grok, rely heavily on SRAM.
It's a critical architectural distinction. When you are training an AI model, you need massive throughput. You use HBM, high bandwidth memory.
Right.
It can move oceans of data, but it has relatively high latency, meaning it takes a moment to initiate the transfer.
But inferencing is different. Inferencing is when the user actually interacts with the trained model. When you ask the AI a question, you expect the answer to start streaming instantly.
Exactly. In inferencing, latency is the enemy. You need memory that can deliver data to the compute cores in fractions of a nanosecond. You need the memory to be as physically close to the processing units as possible. That is where SRAM, static random access memory, comes in.
How does SRAM differ physically from the DRAM or HBM we hear so much about?
Well, dynamic RAM, or DRAM, stores data in tiny microscopic capacitors.
Okay.
But capacitors leak charge over time, so the memory controller has to constantly read and rewrite the data, refreshing it thousands of times a second just to remember what it's storing.
Thousands of times a second.
Yes. That refresh cycle burns power and adds latency. SRAM, on the other hand, uses a flip-flop circuit, usually consisting of 6 transistors per bit of data. As long as power is supplied, it holds the data perfectly steady, no refresh cycles. It is blindingly fast.
But the trade-off is size, right? If you need 6 transistors just to store a single 0 or 1, SRAM takes up a massive amount of physical space on the silicon die compared to DRAM.
Exactly. It's fast, but it's incredibly expensive in terms of silicon real estate. So designing highly dense, power-efficient SRAM at the bleeding edge of physics, like on a 3 nanometer or 2 nanometer node, is an incredibly specialized art form.
And this is where Marvell's history comes into play. They have a long legacy of designing best-in-class SRAM intellectual property, stretching all the way back to their acquisition of Avera, which was originally the custom silicon division of Global Foundries, which itself absorbed IBM's legendary microelectronics division.
That historical context is so crucial. When AWS, Google, or Microsoft come to Marvell and say, we need a custom inference chip tailored specifically for our proprietary large language model, and it needs ultra-low latency memory, Marvell isn't starting from scratch.
Right.
They have a massive, proven library of advanced SRAM designs, high-speed input-output interfaces, and cutting-edge packaging technologies ready to go. They offer a complete de-risked toolkit.
They aren't just a vendor, they're a co-engineering partner.
Exact.
Okay, so the growth numbers are phenomenal. $16.5 billion next year, $10 billion in custom silicon by FY29.
Huge numbers.
But if you are a retail investor analyzing this transcript, you have to look for the hidden risks.
Always.
And my alarm bell started ringing violently when I read a specific comment from the CFO, Willem Meintjes. He stated quite plainly that management is making $1 billion in strategic prepayments to their suppliers this year.
Yeah, it's a massive capital allocation.
$1 billion. They are taking $1 billion of operating cash flow and handing it over to the suppliers in advance before any product is delivered, just to secure future manufacturing capacity.
Sounds scary.
On the surface, that sounds like a colossal gamble. What if the AI bubble pops? What if the hyperscalers slow down their capital expenditures? Marvell is suddenly on the hook for $1 billion of wafer capacity they don't need.
I see why that appears reckless. I really do. But if we analyze the brutal realities of the global semiconductor supply chain, this prepayment is actually the single strongest bullish signal in the entire earnings transcript.
Okay, I'm going to need you to unpack that. How is risking $1 billion a sign of safety?
Because of where those chips are made. Marvell relies on advanced foundries, primarily TSMC in Taiwan, to manufacture these complex 5 nanometer and 3 nanometer chips.
Right, Taiwan Semiconductor.
TSMC's leading-edge manufacturing capacity is arguably the most fiercely contested, strategically vital real estate on the planet right now. Everyone, NVIDIA, AMD, Apple, Qualcomm, is fighting for wafer allocation.
Because there are only so many EUV lithography machines in the world. The capacity is fundamentally capped.
Right. And you do not hand over $1 billion in non-refundable cash to secure future capacity based on a guess.
Okay.
You do not make that prepayment based on a rosy internal forecast.
So you're saying they only write that check if they already have the money guaranteed on the back end?
Exactly. Chris Koopmans, the chief operating officer, addressed this head-on during the Q&A when an analyst from Wolfe Research pressed him on capacity constraints.
What did he say?
Koopmans explained that the only way to manage supply in this environment is by building tight, transparent relationships with the foundries, providing a rigorous 3 to 5 year forecast, and backing that forecast with hard cash.
But how does Marvell know what their forecast is 3 years out?
Because there are only a handful of hyperscalers driving this massive infrastructure build-out, and Marvell is intimately embedded in their design processes.
Oh, I see.
Marvell knows exactly what hardware architectures these cloud providers are going to deploy in 2027 and 2028, because Marvell is currently co-designing the chips with them today.
The cloud providers have already signed non-cancelable orders. That $1 billion prepayment isn't a gamble, it's a lock.
It's a total lock.
It's Marvell cementing their spot at the front of the TSMC manufacturing line because their Tier 1 customers have already legally committed to buying the finished product.
It completely de-risks their massive FY28 guidance. It proves the demand isn't speculative, it's contracted, visible, and highly durable.
Let's shift gears to another area of massive growth highlighted in the call, DCI, or Data Center Interconnect. Management projected their DCI revenue to reach a $1 billion annualized run rate during fiscal 2028, doubling what they did just recently in fiscal 2026.
Yes.
What is driving this explosive growth in connecting data centers together?
This ties directly back to the transition to agentic AI and physical limits of power grids that we discussed earlier.
Running out of power in one building.
Exactly. Originally, DCI optical modules were used by hyperscalers primarily for traditional front-end network connections.
Like saving an email or a photo to a server in Virginia, and the data center automatically making a backup copy in a server in Ohio for redundancy.
Yes. It was standard asynchronous data transfer. But now an AI training cluster might physically span across 2 or 3 different data center buildings within a single metro region.
Because one building just can't handle the power load.
Right. So the incredibly fast, ultra-low latency back-end network, the network where the GPUs are actively talking to each other during the live processing of a workload, must now extend between the buildings. Management refers to this as a scale-across network.
Scale across. So instead of scaling up inside one server rack or scaling out across one building floor, they are scaling across entire geographical campuses.
And the aggregate bandwidth requirements for a scale-across network are projected to be more than 10 times higher than traditional front-end DCI networks.
10.
Easily. Furthermore, because you are now transmitting the raw, unencrypted thoughts of the AI between buildings, potentially crossing under public streets or through shared infrastructure, you need hardware-level security.
Because you can't have someone splicing into the fiber optic cable under the street and stealing the weights and parameters of a $1 trillion AI model.
Exactly. This requires integrated MAC-S security. MAC-S provides line rate, point-to-point encryption over Ethernet links.
Okay, but doesn't encryption slow things down?
That's the challenge. Encrypting and decrypting data at 1.6 terabits per second using AES-256 encryption requires incredibly powerful, dedicated cryptographic silicon. It can't be done in software. The latency would just kill the AI's performance.
So Marvell built it into the hardware.
Yes. Marvell is leading this transition with the industry's first secure 1.6T ZR and ZR Plus DCI modules, embedding the cryptography directly into the optical transceiver.
It is staggering to think about the sheer volume of data moving continuously between these XPUs.
It really is.
This leads me to another acronym they kept repeating during the call, AEC. They mentioned strong interest in their Golden Cable program and that AECs and retimers are ramping rapidly, with combined revenue expected to more than double this year. Let's unpack the AEC. What is it, and why is it replacing standard wiring?
So AEC stands for Active Electrical Cable. To understand its importance, visualize a standard server rack.
I'm picturing it.
You have multiple servers stacked on top of each other, and they all need to plug into a top-of-rack switch to communicate with the rest of the data center. Traditionally, you connect them using passive copper cables. It's cheap, reliable, and requires no power.
Just a standard copper wire carrying electrical pulses.
Right. But as port speeds increase from 100 gigabits to 400 gigabits and now to 800 gigabits per second, physics gets in the way. At those extreme frequencies, electrical signals degrade violently over copper.
Like we talked about earlier with the skin effect.
Exactly. You suffer from severe signal attenuation and the skin effect, where the high-frequency electrons crowd to the surface of the wire, massively increasing resistance.
So the signal starts out as clean, sharp, square waves, clear ones and zeros. But by the time it travels just a few feet down the copper wire, it arrives looking like a smeared, unintelligible analog mess.
Precisely. At 800 gigabits, a passive copper cable can only be a few inches long before the signal becomes pure noise. You can't even reach from the bottom server to the top of the rack.
So how does an active electrical cable solve this without reverting to expensive fiber optics?
By embedding microchips directly into the connectors at both ends of the copper cable. These chips are DSPS digital signal processors, specifically acting as retimers.
Retimers.
Yes, the retimer sits inside the cable plug, samples the degraded, noisy analog signal arriving from the wire, uses complex error correction algorithms to figure out what the original ones and zeros were supposed to be, reconstructs a perfectly clean digital signal, and then retransmits it into the server.
It's acting like an active translator, cleaning up the mess in real time.
Yes, and by doing this, an AEC can extend the reach of a high-speed copper connection to a couple of meters, which is exactly what is needed to span a server rack. It's cheaper and consumes less power than using lasers and fiber optics for such short distances.
That's brilliant.
Marvell is dominating this retimer space. They have secured design wins with 3 of the top Tier 1 US hyperscalers for this specific golden cable program.
Think about the implications of that. Even the humble copper cable, the most basic physical component of networking, now requires highly advanced semiconductor technology from Marvell just to function in an AI data center.
It's incredible how much tech goes into the wiring now.
Let's look at another critical bottleneck they're addressing: memory. Blaine Curtis from Jefferies asked a highly technical question about the CXL opportunity alongside accelerators. What is CXL, and why is it suddenly a focal point for Marvell?
CXL stands for Compute Express Link. This addresses one of the most painful bottlenecks in large language models, which is KV caching.
Let's explain the KV cache for a second. When you are interacting with a model like ChatGPT, the AI has to store the entire history of your conversation, the context window in its memory, so it can generate the next word accurately.
Right.
It isn't just doing raw math on your current prompt. It's constantly referencing everything you've already said.
That stored context is the KV cache key value cache. As context windows grow from a few thousand tokens to millions of tokens, the KV cache becomes enormous.
And what's the problem with that?
The problem is that standard high bandwidth memory attached directly to the GPU is incredibly expensive and physically limited in capacity. Once the GPU runs out of local memory for the KV cache, performance just falls off a cliff.
So how do you give a GPU more memory if you can't physically solder any more RAM chips onto the board?
Well, historically, you couldn't do it efficiently. Connecting external memory over standard PCIe buses introduced way too much latency. CXL changes the architecture entirely. It is a new open industry standard interconnect built on top of the PCIe physical layer, but it maintains memory coherency between the CPU, the GPU, and attached devices.
What does memory coherency actually mean in practice?
It means the GPU can look at a pool of external memory sitting on a completely different server blade and treat it as if it were its own local memory.
Oh, wow.
Yeah, it allows you to pool memory resources dynamically. Instead of memory being permanently trapped inside one specific server, a CXL switch allows multiple accelerators to dynamically share and allocate a massive centralized pool of external memory on the fly.
It treats memory like a shared municipal utility, rather than a localized resource you have to hoard.
Exactly. And through its acquisition of XConn, Marvell acquired incredibly advanced CXL 3.1 switch solutions. Matt Murphy noted that the soaring, prohibitive costs of AI memory are forcing hyperscalers to rapidly adopt CXL-based designs.
Which means more revenue for Marvell.
Absolutely. Marvell projects their XPU-attached business, which includes these CXL controllers and network interface cards, to surpass $1 billion in revenue in the next couple of years.
$1 billion in revenue just from the accessories attached to the main AI chips. It really highlights how complex the ecosystem around the GPU has become.
That's a whole universe.
And this brings us back full circle to the Celestial AI acquisition and the future of optics. Tori Svanberg from Stifel asked about the dynamics in the scale-up interconnect market, specifically pressing management on copper versus optical connections, and NPO versus CPO. Let's decode those acronyms. NPO and CPO.
NPO stands for Near Packaged Optics. CPO stands for Co-Packaged Optics. This represents the next major evolutionary leap in data center hardware.
Right now, if you look at a high-end network switch, the optical transceivers are pluggable modules. They slide into the front panel of the switch chassis, kind of like USB drives.
Right.
The light comes in from the fiber optic cable, hits the transceiver on the front panel, gets converted to an electrical signal, and then that electrical signal has to travel several inches across a printed circuit board to reach the main switch ASIC in the center of the box.
And we run right back into the copper problem. At 51 terabits or 100 terabits of aggregate switching bandwidth, driving an electrical signal across several inches of circuit board requires an immense amount of power.
And that creates heat.
The heat generated is catastrophic. You hit a thermal wall where you literally cannot cool the switch fast enough to keep it from melting.
So how do near-packaged and co-packaged optics solve this thermal wall?
By moving the optical conversion process as close to the main chip as physically possible. With near-packaged optics, you move the transceivers off the front panel and place them on the motherboard, just millimeters away from the main switch chip.
And co-packaged optics takes it a step further.
Co-packaged optics integrates the silicon photonics engine, the lasers and the modulators, directly onto the exact same semiconductor substrate as the switch chip itself.
Wait, on the same chip package?
Yes. The fiber optic cable plugs directly into the chip package. There is virtually no electrical trace routing across the circuit board.
You eliminate the copper penalty entirely.
Yes. It drastically reduces power consumption, lowers latency, and vastly increases the bandwidth density. When Matt Murphy answered the question about this market, he emphasized that hyperscalers are no longer looking to buy piecemeal components. They want end-to-end solutions.
Because of the celestial AI intellectual property, combined with Marvell's existing custom silicon capabilities, Marvell can walk into a hyperscaler and offer the entire stack.
The whole thing.
They can build a custom compute accelerator, they can build the scale-up switch it connects to, and they can build the co-packaged silicon photonics engine that integrates into both chips to connect them with light.
It is an unmatched level of vertical integration in the infrastructure layer. Marvell expects their scale-up optics business to more than double their prior outlook, reaching around $300 million next year. And Murphy made it clear this is just the nascent beginning of a major multi-year growth cycle.
We have covered an immense amount of ground here. We've dissected the GAAP versus non-GAAP accounting noise, the shift to agentic AI and mixture of experts, the 70% growth in interconnects.
We really have.
We've gone deep into the physics of plasmonics, the NVIDIA AI-RAN partnership, the $1.5 billion guidance raise, the ironclad $1 billion TSMC prepayment. We've looked at DCI scale across networks, AEC retimers solving the copper crisis, CXL memory pooling, and co-packaged optics breaking the thermal wall.
It's a massive amount of innovation.
With all of this record-breaking data, an expanding total addressable market, and deeply locked-in demand from the world's biggest tech companies, we need to bring it home for the listener's portfolio. Based on the fundamental analysis of this Q1 earnings call, what is the actionable perspective on Marvell Technology?
If we synthesize all the data points, the operational metrics, and the strategic positioning, the conclusion is highly constructive.
I'm going to take a firm, highly opinionated, and highly bullish stance on these results. If you are a retail investor listening to this, and you are trying to find a way to capitalize on the AI revolution without taking on the extreme valuation risk of the pure-play GPU makers, Marvell represents the ultimate infrastructure play.
I agree.
Everyone knows NVIDIA. Everyone knows the headline chip makers, but those trades are incredibly crowded, and their current valuations demand absolute perfection for years to come. If a new competitor builds a slightly faster compute chip, those stocks could face massive corrections.
Building on that, the risk profile of Marvell is fundamentally different. It doesn't matter who wins the ultimate GPU compute war.
Exactly.
Whether the future is dominated by NVIDIA H200s, AMD MI300s, Google TPUs, or Amazon Trainium chips, they all rely on the same fundamental laws of physics. They all generate massive amounts of data that must be moved out of the chip, across the server rack, and between data centers at zero latency speeds.
They all need the elevators. Marvell is laying the transcontinental railroad for the AI gold rush. They are supplying the water rights.
That's a great way to put it.
If you are currently holding MRVL stock, management has just provided you with a rare gift in the tech sector. Incredible, highly visible, multi-year revenue clarity. They have a $1 billion prepayment locked in with foundries that guarantees capacity for a $16.5 billion year in FY28.
Yes.
They have a clear line of sight to $10 billion in custom silicon by FY29. This is the definition of a stay-the-course scenario. Do not get shaken out by short-term macroeconomic volatility or confusing GAAP accounting noise related to acquisitions. The underlying cash generation of the core business is roaring.
And if you are considering adding the stock to your portfolio, you have to frame the company correctly. You have to remember the statistic we opened with. Data center revenue is already 76% of their total business.
76%.
They've successfully shed the weight of slow-growing legacy consumer electronics. They are a pure-play AI infrastructure asset.
When you buy Marvell today, you are buying the high-speed nervous system of the future internet.
Absolutely.
Which brings me to a final provocative thought I want to leave you with as we wrap up this deep dive. Something for you to mull over as you watch the AI landscape evolve over the next few quarters.
Okay, let's hear it.
During the call, management repeatedly mentioned the shift toward agentic AI. We touched on how this creates more east-west traffic in the data center. But let's extrapolate the societal impact of that.
Sure.
Imagine a world, maybe just 3 to 5 years from now, where the internet never sleeps. Not because humans are endlessly scrolling on their phones, but because millions of autonomous AI agents are talking to each other 24 hours a day, 7 days a week.
Okay.
They are negotiating complex B2B supply chain contracts, executing high-frequency trades, managing municipal power grids, and conducting millions of simulated medical research trials, all autonomously, machine to machine, without a single human prompt initiating the action.
The sheer volume of raw data generated by constant, autonomous machine-to-machine interaction is almost incomprehensible compared to today's human-driven internet traffic.
Exactly. So here is the question for you to consider. As this autonomous agentic AI future unfolds, could we reach a tipping point where the raw compute power used to generate an AI's thoughts becomes commoditized? As chips get faster and cheaper to produce, does the intelligence itself become cheap? And if the intelligence becomes cheap, does the absolute bandwidth required to move those massive thoughts safely and securely between machines become the most valuable commodity on Earth?
That is a fascinating thought experiment.
Will the elevators eventually become far more valuable than the skyscraper itself?
It's very possible.
It's a fascinating paradigm shift to consider. Think about that the next time you see a massive new data center being constructed on the outskirts of your city. It's not just a warehouse full of computers.
Yeah.
It's a critical, high-speed node in a rapidly evolving planetary scale nervous system.
Well said.
Thank you for joining us on this Talk Tickers Deep Dive. We hope we achieved our goal of breaking down the technical jargon, focusing on the hard data, and delivering actionable insights for your portfolio. Stay curious, keep digging into the numbers, and we'll catch you on the next Deep Dive.